Hello everyone. My name is Aditya Gupta. I'm a chartered accountant by profession. I'm here to discuss about the August 6 RBI circular which talks about the one-time restructuring. In its monetary policy review, the Reserve Bank of India finally gave the green signal to a loan restructuring scheme for the stressed borrowers. A special window providing a one-time loan restructuring to companies as well as individuals who has been affected by the COVID-19 pandemic. Now the first question arises is the who will benefit from the scheme specifically. So to make you clear, only those companies and individuals whose loans account are in default for not more than 30 days as on 1st March 2020 are eligible for one-time restructuring. And for corporate borrowers, the banks can invoke a resolution plan till 31st December 2020 and can implement it till 30th June 2021. Also, there's another condition that such loan account should continue to be standard till the date of invocation of the resolution plan. As we know, the COVID-19 pandemic has badly impacted the sectors like tourism, hospitality, real estate, but this one-time restructuring window is available across all the sectors. Also, it is expected to provide relief to companies that were servicing loan obligations on time but could have found it difficult after the March as the pandemic affected and the lockdown has occurred, which affected their revenues, customers, labor, supply chains, etc. But to slightly, I want critique this scheme on one aspect that the companies though that were already in default for more than 30 days as on 1st March 2020, but they were on the path of regain the profitability, but that got hit when the lockdown was imposed. Those kinds of companies cannot avail this facility. Now, in respect of the personal loans, the resolution plans can be invoked till 31st December 2020 and will be implemented within the 19 days thereafter. Now, another question that arises that how will it implement it? So the Reserve Bank of India has set up a 5-member expert committee headed by KV Kamath, the former chairman of the ICICI Bank, which will make recommendation on the financial parameters that will be required to be factored into the each resolution plan for borrowers with an aggregate exposure of 1500 crore or more above at the time of invocation. Generally, the key feature of the resolution plan can be consist of an additional facility that may be provided to address the financial stress of the borrower on account of the COVID-19. Interim finance may also be provided before resolution plan implementation. There can be a tenure extension, but however, with or without payment of money, but by a period of not more than 2 years. Also, there could be a conversion of debt into equity or other marketable, non-convertible debt securities that can be allowed. But keeping in mind, there's a factor that the committee will also undertake a process validation of those resolution plans which are above the specified threshold. Moving forward, how will this scheme impact the banks? The biggest impact will be that the bank will be able to check the rise in the non-performing assets to a great extent. However, it will not bring down the NPAs at the present level, which is close to 9 lakh crores within the system right now. And as we have seen in the past that there are many borrowers, even the lenders have misutilized those schemes. So does this new scheme have any safeguards against that misuse? I feel so. Because the RBI is building the safeguards in the resolution framework to ensure that it does not lead to the evergreening of bad loans as in the past. Because here the restructuring of large exposure will require independent credit evaluation by rating agencies and also a process validation by the expert committee. Those resolution plan has to be validated by the expert committee. But unlike in the case of restructuring of large corporate exposure for personal loans, individual loans, there will be no requirement for third party validation by the expert committee or by credit rating or need for any intercreditor agreement. Because if it involves multiple lenders to a single borrower, the banks need to sign an intercreditor agreement. And to mitigate the impact of expected loan losses, bank need to make a 10% provision against such account who are under resolution. Mind you, for banks, those not willing to be part of the intercreditor agreement, a penal provision of 20% has been specified here. Now, also, we can look at the impact that what are the major differences with the previous restructuring schemes vis-a-vis this current circular, August 6 circular. The most important thing is the earlier restructuring schemes did not have any entry barrier. Unlike the current schemes that is available only for companies that is facing COVID related stress, as identified by the cutoff date of March 1st, 2020. And also there has been a strict timelines for invocation of resolution plan and its implementation have been defined in the scheme very clearly, unlike in the past which was largely open ended. And the structuring also makes signing of the intercreditor agreement largely mandatory for all the lenders once the resolution plan has been majority voted for. Otherwise, they face twice the amount of provision required. Also, there is an inbuilt mechanism of independent external valuation, process validation. Resolution plans has to be vetted by the expert committee if the exposure is more than 1500 crore, and specific post-resolution monitoring that includes those safeguards. So this is from my side. Thank you so much.
Stay tuned to We Listen by subscribing to our podcast.